Howdy, Jacob here. Today we're looking at One Gas. So some of the financials, it has a 4.07% dividend yield, $3.6 billion market cap, and a $5.5 roughly billion enterprise value. It's in the gas utilities industry. Some tells me this is going to be a similar company to the other gas utilities businesses that we see producing high cash flow yield or high dividend yields with low cash flow. So it looks like they distribute services in Oklahoma, Kansas, Texas area. $1.7 billion in revenue in 2013, up to 2.6 in 2022. Again, same thing as similar companies where it's down and then down for 7 years from 2013 and 2020, and then the last 2 years spiked like crazy, likely from inflation. And so earnings look fantastic, increase from 99 to 222. However, on the cash flow side, we're seeing negative cash flow, 114 cash flow million, negative cash flow, $74 million, way negative, 900, but this is way negative. And so, a 5-year average of free cash flow is negative. They don't produce positive free cash flow based on a 5-year average, and they're still paying out $142 million. How are you doing that? Well, issuing shares, issuing debt, which you can literally see on their cash flow statement here. Issue of $5 million, $19 million, $27 million, $134 million, and then for debt, issue $38 million, $217 million, $200 million, $2.1 billion, and then bought back a little bit here. But if we look at this cash flow, $10 million cash on hand with $2.3 billion in long-term debt. I don't understand how lenders are not coming after these types of businesses. Like, I know that a lot of these places have monopolistic values in the regions that they serve, but it's just absolutely crazy to me how a lender's not looking at this balance sheet and they're sending out dividend of cash flow they don't produce, so they keep going into debt to pay for this dividend. It just doesn't make sense to me as someone who understands that businesses, the lifeblood of a business is cash flow, and the health of a business is their cash flow and their balance sheet. And this balance sheet has no liquidity in comparison to its interest-bearing debt. They have $573 million short-term debt. They have $2.3 billion in long-term debt, and they have $10 million in cash on hand. So, if I were to put this into perspective of an individual, let's say this individual owns. This is gonna sound kind of silly, but let's put this in millions. Okay, so I own 5.6 million of commercial real estate. Let's say I owe 2.3 billion in mortgage debt. I own 573 million in short-term debt. That means it's coming up pretty quick. And I have wait, how did I say that? Yeah, and then I have $10,000 on hand. So I have $10,000 on hand. Yeah, I own 5.6 million in assets of, let's say, real estate, but then I owe 2.3 million on that real estate, and I have 573 million or 573,000 short term, very recently coming up. I have interest bearing debt that's coming to me where I need to pay it off, and I don't have the cash on hand for that. And my cash from operations, the cash I'm getting from literally operating my business, is negative. I don't produce any. And so how am I going to fund that? Likely with long-term debt. And it's a cycle, and that's what we're seeing here, where long-term debt has gone from $1 billion to $2.3 billion, and cash equivalents is just not improving. And I really don't understand these types of businesses. And if you understand them, that's fantastic. I hope maybe you can write it down for me, or I mean, it's fine. There's so many businesses out there. I don't need to understand every business, but I know that cash flow is the lifeblood of a business, and a balance sheet is the health of a business along with cash flow. So these assumptions are just going to be wishy-washy. I mean, they can't afford this dividend, so I'm just saying divide by five. I mean, they do have likely a moat in their region, so they'll probably grow with inflation, and then 13 PE because I mean their return on invested capital is pretty cruddy, and so yeah, they have monopolistic tendencies and values from that perspective. They just don't give a good return on the money reinvested into the business. A 10, 5, 1. Okay, so this is going to be with these assumptions, the stock price would have to fall 68% to get a 15% return. But I mean, are these assumptions reliable? I don't know if they're reliable. Um, there's just too many more consistent businesses that I view as much stronger that I don't think you need to be reaching on a company's 4% dividend yield when there's companies that have less than 50% payout ratios on their 5-year average free cash flow that are just they're so much healthier that are producing the 4% dividend yield. So just don't see a dividend yield that's attractive to you, that's best in your situation. Like, let's say you have $1 million, you want to live off of 40,000 a year. That 4% dividend yield sounds fantastic because it's giving you that. But look into the business if that's the type of thing that you're interested in, because the business can portray a certain story and the business can portray a certain story and the numbers just don't show it to be accurate. And so yeah, they've been increasing their dividend 10% a year or 7% a year almost the last 8 years or more. um, or they've increased it more than 7% a year for the last 5 years. But if you actually look at the cash flow they're producing and the health of their balance sheet, this is just not what you want in a company, and definitely not what you want in a dividend paying company where they could cut it to zero if the lender's like, hey, we need this money now. And they're going to have to sell off assets. They're going to have to stop paying the dividend. It just goes to almost worst case, which you don't want to be doing. You want a very solid, stable company with stable producing cash flows where the payout is not greater than 50, 60%. It just depends on that number is variable depending on where the business is in their cycle, you think. But yeah, a business like this just not attracted to. And I mean, like I said, we got to a price that it needs to fall 68%, but even if it did, I just these assumptions on the cash flow are just silly to me. But I hope everyone learned something, had a good time. Sorry I was ranting so much. It's just tough here, like looking at these numbers, and to me, it's almost like the businesses are lying where they're saying they have a 4% yield, but they just can't afford it. They're just issuing shares, issuing debt to fund it, and just please don't get trapped by a dividend yield without looking at the business first. Um, and same with the companies, company stock price going up, 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 whatever. Look at the business. That's what matters. Like stock price in the long run is going to follow the business, not this fugazi of up and down action of the market day by day. Uh, yeah, I hope everyone has a good rest of their day. Thank you.